Okay, good morning. Today we have a lot on our agenda. We are going to finish Chapter 3. We covered the first half of Chapter 3 on Monday. We also talked about the exam on Monday. At the end of class, we'll have a few minutes. You can ask questions about the exam. I do ask both in person and online, you hold exam questions till the end of class. And again, if I received a couple emails last night from people, so just keep in mind, if you have not viewed Monday, it is required viewing. You don't want to be surprised on the day of the exam by something you didn't know. So make sure you watch from Monday. We also did some of this chapter. So exam questions at the end of class. So talking about what's due this week, every section, we have homework on Chapter 3, and we have an exam info quiz that was available beginning Monday, and it's due Saturday. So those two things are due Saturday. Before you take the exam, you have practice exam 1 quiz due February 11th by 4 p.m. The Learning Catalytics session ID is up there. Get logged in. There is a question up there. If you're putting 2 words in, put double quotes around, or leave the space out between the words so we don't get the words separated. So we're going to be closing that Learning Catalytics question in just a minute or two, so you want to make sure you get logged in and get that question answered. Exam 1 is next week. Again, I'm going to be talking about Exam 1 at the end of class, so these are just a couple administrative points I wanted to make. Okay, there is no class next week. Your job next week is to take the exam, okay? You need to prepare for the exam. However, whatever you do for that, that is your job next week. There is no homework next week, except remember the practice exam 1 quiz, which is a required quiz, is due before you take the exam. Okay, if you are ever disconnected during a quiz, and this might have happened to you already, or if it happens to you during an exam, so you lose your connection and all of a sudden either My Accounting Lab closes or your computer's frozen and you need to restart. That's not a problem. Your quiz or your exam are not submitted until you click the submit button and it says, are you sure? So you have to click twice to submit it. So if this happens to you, if you get disconnected during an exam or a quiz, all you have to do is restart your browser. Sometimes if your browser doesn't close, you need to actually close it and then sign back into My Accounting Lab. Don't panic because it'll say 1 of 2 attempts has been used or whatever. You just click on Take a Quiz again, the same way you went into it, and you will be back in your attempt until you actually submit it or the due date comes. And if you're in an exam and that happens, the proctor needs to sign you back in. Okay, so not a worry about panic. Don't panic. If you lose your connection, you can get back into it. It works just fine. Once in a while, if that doesn't work, then do the standard restart your computer. If things don't work, restarting your computer should be on your list of things to do, but that should be fine. Okay, now we're on Learning Catalytics. This question is going to be open about another 30 seconds, so make sure you get your answer in. It lists an example of a liability account, and we are going to app share now. No, not yet. Just let it sit there for a second. Okay, so another 10 seconds or so on this one. I'm redoing this one because we had a lot of answers that weren't right on target last week. This question should be very easy for you at this point. You should be able to identify types of accounts. That's going to be assumed when you take the exam, that you can identify different assets, different liabilities, equity accounts. Okay, why don't you go ahead and close it. Okay, so accounts payable is probably the most common answer we get. That is the first account listed. Remember that the liabilities and equity, or liabilities and assets, are listed in a specific order. Liabilities in terms of how soon they're due. Accounts payable is typically due the soonest, so we go from soonest due to last due. And in balance sheet assets, we go from most close to cash to longest term asset. So we see accounts payable, notes payable, unearned revenue. Those are all good. Salaries expense is not a liability. Salaries expense is an expense account, which is a sub category of equity. Loans, you would see loans. I can't tell if it's one word or two here. It would be loans payable. Unearned revenue is, I cannot think of any account that has the word balance in it. Can you, Haley? No. So if your answer had balance in it, it wasn't right. I'm not sure what student goes with, but it's not right either. And trail is not right. So, okay. So, but we get the idea that it's notes payable, accounts payable, unearned revenue. Those are the ones that I'm seeing here that are right. Okay. So we're going to close that one, and now we're going to go to the next one. Do you want to load the next? Okay, now this next question relates to what we did Monday. Okay, now I'm going to get it. Yeah. I'm going to answer Ryan's question. So you can just, I know you just were typing, but I'm going to address that. Okay. Someone asked, is student loans not a liability? Remember, we are talking first about, there's two reasons that would not be right. Number one, we're typically talking about a business. We're not talking about an individual in this class. So a business would not have student loans. If we were to leap and say, well, we're talking about an individual, it would be loans payable or student loans payable. You just don't say student loan. So that's why that would not be right. But typically a business is not going to have student loans. So. Okay, so this question that's up, which of the following is not one of the three basic categories of accounting adjustments? This was at the end of class on Monday. We're going to have it open for about another 10 seconds. And the answer there is expenses. The three categories of adjustments are deferrals, depreciation, and accruals. We're going to do some homework problems today that we do some of those adjusting entries. So we're going to go to short exercise 3.7 now. Okay, so short exercise 3.7. We're making some adjusting entries. These are prepaid expenses. So these are deferrals. When we talk about deferrals, cash has already changed hands. So either unearned revenue is involved or prepaid expenses. So deferrals, the cash has changed hands, and now the transaction, the earning or incurring is going on. Accruals are the opposite. Cash changes hands after we recognize it. So the first one, on October 1st, Paradise Travel prepaid $6,000 for 6 months rent. Okay, so this makes it easy math-wise for us. $6,000, 6 months rent. Before I do anything else, I know that rent is $1,000 a month. We paid it in advance, so October October 1st, we paid it. So when we pay it, we're going to have this asset called prepaid rent, and the other side of it is going to be cash going out the door. Prepaid rent is this asset. Give the adjusting entry to record rent expense at October 31st. So when we originally paid the rent, this is not part of the exercise, but when we pay the rent, we're going to be debiting prepaid rent, this asset, and we're going to be crediting cash. So we have this asset on our books for $6,000 that represents rent for the next 6 months. So that's an asset because it has future economic benefit to us. Our rent is paid each month. So at the end of October, we need to recognize that we've used up $1,000 of rent, basically, because we said it's 6 months, $6,000, so $1,000 a month. So at the end of October, we need to make an adjusting entry to reduce that asset. That asset at the end of October is not worth $6,000 anymore. It's only worth $5,000 because we used up a month of rent. We do these based on months, not days. Just this is a month of rent. So we are going to, our adjusting entry is going to debit rent expense for $1,000. There's different ways you can get to that $1,000. You could take $6,000 times 1 month out of 6, or however you do that. So you're debiting rent expense to acknowledge that we've used rent, we've incurred rent for the month of October, and then we're crediting prepaid rent, which is an asset. This is reducing it. Okay, now it says, so we did give the adjusting entry to record rent expense at October 31st, include the date of the entry and an explanation. So we've done all that. We have October 31st, the explanation is to record rent expense. Then it says post all amounts to the 2 accounts involved and show their balances. So when we talk about posting, we're taking from the journal entry into the account. We use T accounts to represent the account. So we're going to have 2 accounts involved here. We'll have rent expense and we'll have prepaid rent. So prepaid rent is on the left, it's an asset, and on the right is rent expense. It doesn't matter which order we put those in. What we're going to see here then is we're going to post the rent expense. The debit goes to the left-hand side of rent expense T account, and the credit to prepaid rent goes to the credit side of the prepaid rent T account. So when we post this rent, what we're actually doing is we are taking this $1,000 here and we're putting it here because it's a credit and it goes on the credit side. Now, the $6,000 that was there to begin with, I could have done this in a couple steps. That was our beginning balance. October 1st, we had paid $6,000 of prepaid rent, so we had this asset. Assets, we know they have a debit balance because we know the normal balance of an asset is debit. So we have a debit balance of $6,000 when we start the month. We post this entry of $1,000 in. So then our ending balance is the $6,000 minus the $5,000, $6,000 minus $1,000, giving us an ending balance of $5,000. We know to put it on the left side because the left side's greater. That is posting prepaid rent. We still have to post rent expense. Rent expense, we're going to post the $1,000 down. There is no beginning balance of rent expense. So we just have $1,000 and then the balance is $1,000. We don't actually have to write the balance in there, that would be, but we're just doing it to be consistent. So that is entry A. That's the adjusting entry and that's posting those amounts to the accounts. The second entry, Paradise Travel, October 1st, paid $950 for supplies. On October 31st, they have $270 of supplies on hand. Okay, so this is a little bit different. Rent was really easy to figure out because we knew we paid $6,000, 6 months, $1,000 a month, we get it. Now, supplies are a little bit different. Most of the time with supplies, if you're at work and you go to the supply closet and get pens, nobody runs and writes a journal entry for that 50-cent pen that you're using. We just use supplies. We get paper out of the supply closet and put it in the copy machine and use it. So we're not running around writing journal entries every time somebody uses it. But we get to the end of the month and we say, okay, we know in this case what they're saying is we bought $950 of supplies. Okay, so when we bought those supplies, we would have an asset called supplies. Once in a while it's called prepaid supplies, but typically supplies. We would have this asset called supplies for $950. Now during the month, we use it. We do not record it every time you use a pen or something, and that's because that would be very, very expensive. It would be very time consuming to record every use of these little things. So what we do instead is we say, okay, we know there was $950 of supplies when we started the month. So at the end of the month, someone goes into the supply closet or wherever we keep the supplies and counts everything in there and then comes up, and in this case, they said, we have $270 of supplies left. Okay, so if we started with $950 and now we have $270 of supplies left, the difference between them is what we used. Okay, it makes sense. It's here's what we started with, here's what we've got left. How did we get from there? We used it. So what we're going to see in this journal entry is we're going to debit supplies expense for what we used. And how we get there is we're going to take what we started with and subtract what we have left, and that will give us our used. If we had purchased more supplies during the month or started with supplies, we'd have to add that in too. You know, here's all the supplies we had available, and then subtract what we have left from this physical count, and that will give us the 680 of supplies that we used. Okay, so that entry is going to look like that. So supplies, you can't say, well, this is how much per month. You have to do some kind of physical count, and then whatever you used is what you're going to record. Once in a while, for your purposes, when you're doing an adjusting entry, it will tell you what the supplies used were. And that's fine. Go ahead and use that. So sometimes you just have to read the facts that are given to you, and either you have to think about it and think, well, how would I know what my supplies used are? Either they give it to you or you have to do some kind of computation like this. And then it says make the required entry, which we did, then post to the accounts and show their balances. So again, we have two accounts here. We have supplies and supplies expense. Supplies, the word supplies all by itself is an asset. Supplies expense is an expense. So what we're going to see there, supplies has the beginning. I'll get that one, and I'll get your question in just a second. Okay, so supplies has October 1st, we bought supplies. So we see that debit in supplies, we increased supplies. Then we had the 680 we used, so that's subtracted. And so October 31st, when we drop a balance in that account, we would have the $950 we started with, the 680 we used. The difference is 270. That's what we have on hand at the end of the period, and that is the value of that supplies asset. So that is listed. Our new balance of supplies, the new asset balance, is $270. So yes, you will be listing the supplies of $270. That's your balance of the supplies. And that answers Alexander's question. Okay, so then the other account posting the 680 of supplies expense. Again, you look at your journal entry and see if you debited or credited it. Debits go on the left and credits go on the right of the T account. So that's all you're doing there. So that's our that's our example of deferrals. These happen to be expenses, but the adjusting entries, those are adjusting entries. We have to make them at the end of the period to make our certain assets and liabilities and expenses reflect what happened during the period. Okay, we have a whole bunch of adjusting journal entries to go through, so we're doing homework. So that was the first homework problem. Okay, any questions on that before we move on? Okay, we're doing another homework problem next, coming up, and it's 3.8. So that was an example of deferral adjusting entries. Now we're going into depreciation. Depreciation is the process of recognizing the expense from a long-term asset that we bought to use in our building. A good example of this is if we buy a car to use in our building, to use in our business. So we buy a car perhaps for the salesperson, and so we own this automobile. We know that automobile is going to wear out eventually, but we look at it and we say, we're going to use this car for 3 years, for example. So we have 3 years we're going to use this car. So we spend $20,000 on the car today. We do not take the $20,000 and put it into car expense right now, because that doesn't match the expense with the period that we're using the car. What we do instead is we say, okay, we're going to take that $20,000 and depreciate it over the 3 years that we're actually using the car. So depreciation is this process of putting the cost of these long-term assets to match them against the periods in which we use them to create revenue. So depreciation, we're going to only hit very, very basic points in this chapter because it is an adjusting entry. But it's a huge topic, and we're going to have a chapter later in the semester on depreciation, those plant assets and depreciation all by themselves. So right now, we're just going to know basically the adjusting entry, and then we'll get more into it later. This problem, short exercise 3A. Suppose on January 1st, a company paid cash of $35,000 for equipment that's expected to remain useful for 5 years. So we have $35,000 for 5 years. Okay, at the end of the 5 years, the equipment's value is expected to be 0. That's thrown in there so we don't have to do an intermediate step that we'll see in a later chapter. So basically, 5 years, $35,000. There's different ways, there's different theories about how you can spread that expense over the 5 years. What we're going to do in this chapter, we're doing the easiest method. It's actually the most common too. It's called straight line. And we're going to take our $35,000, divide by 5 years basically, and say, boy, we have $7,000 of depreciation every year. Because we know we're going to use this every year for 5 years, so we take $7,000 every year. Now, so we know $7,000 every year. Now, the weird thing, there is one very different thing about depreciation, and these are called plant assets or property, plant, equipment. The weird thing about them is if we were doing a prepaid asset and doing the adjusting entries for it, we take that directly out of the prepaid asset. So like we just saw, prepaid rent, we just take it out of prepaid rent, and at the end of 5 years or however long we would have prepaid rent for, the balance is 0. We don't do that with depreciation. With depreciation, when we buy something, like in this case, we bought equipment, the equipment account, that's an asset, and that's going to be on our balance sheet for the cost, the $35,000. So that asset sits on our balance sheet for the whole 5 years. We never reduce that for depreciation. We have a new kind of account called accumulated depreciation. And this is the first of our exceptions. You know how we said that assets have normal debit balances? Accumulated depreciation, we're going to see it coming up here, is known as a contra asset. Accumulated depreciation is a contra asset, which means it reduces its companion asset. So we have equipment, and then we have accumulated depreciation on equipment. We'll see that coming up here, but I wanted to show that. So we'll just dig into this and see it. Okay, so we're going to make journal entries to record the purchase of equipment and the annual depreciation, and then it tells us what accounts. So the first thing, record the purchase of the equipment. So we're going back to January 1st. So January 1st, we bought equipment. This is an asset. So we're going to be debiting equipment and crediting cash. So what we're going to see on January 1st is we're going to debit equipment for $35,000. We're going to credit cash, and that's our purchase. And that was January 1st, we purchased equipment. In real life, our memo lines are going to reference invoice numbers and things so we can trace things back. But that's the initial purchase of the equipment. That is not an adjusting entry. That is simply a transaction that happened. Yes, accumulated depreciation will always have a category it's tied to. So we'll have, except in our accumulated depreciation, we may use it as just a generic total. So in real life, we have accumulated depreciation for equipment and for buildings, so we have separate ones. Sometimes in here we'll just have one, but it really won't make a difference to us. But it's always to the category. It's always going to offset our plant assets. Okay? Yeah, and I'm going to answer, since I'm going to, yeah, okay, but that's good. Yes, and we are debiting equipment because it said we purchased equipment, and it tells us in the very first sentence it says we paid cash. So that's why we have that entry. So that is the entry when we bought the equipment from the very first sentence of the exercise. Okay, so next up it says B, entry B is annual depreciation. Okay, so we already established that we've paid $35,000. This is good for 5 years. That's $7,000 a year. The depreciation adjusting entry will always debit depreciation expense, credit accumulated depreciation. Always. That will always be the depreciation adjusting entry. So what we're going to see here is okay, we're going to debit depreciation expense. You may or may not need that word equipment. Sometimes you do, sometimes you don't. You will not need to make that selection in homework. It'll either have depreciation expense equipment or it'll have depreciation expense. So that's not a cut and dried rule about that. But we're going to debit depreciation expense, and it's straight line depreciation, so we're just taking the $35,000 divided by 5. And then our credit is always going to be to accumulated depreciation. Accumulated depreciation is a contra asset, meaning it's opposite, it's contrary to all the other assets, meaning it has a normal credit balance. Okay? So contra assets offset their companion asset. So accumulated depreciation will always be shown with the plant asset, that either the main category or, in this case, equipment. So you will always see, we never depreciate directly in the asset itself. Equipment, for this equipment, is always going to stay $35,000, but accumulated depreciation is going to grow every year. So we have equipment have a debit balance, and accumulated depreciation is this running total of all the depreciation we've taken on that asset. So after 1 year, accumulated depreciation will be $7,000. So our equipment is $35,000 with accumulated depreciation of $7,000. So the difference is what called the book value, which I think we get to. Yes, we're going to get to that. I'm getting ahead of myself. So this is the adjusting entry for depreciation. When you have a depreciation adjusting entry, it will always debit depreciation expense, always credit accumulated depreciation. Always, always, always. Okay, so you don't have to figure that journal entry out. It will always debit the expense, credit accumulated depreciation. Okay, so that's requirement 1. Those are the two adjusting. That's the first one we did was the transaction recording. The second one was the adjusting entry. Now we go on to post to the accounts and show their balances. So when we're posting to the accounts, what we're doing is that equipment debit is going to go in the T account on the left. The depreciation expense is going to go in the T account on the left is $7,000, and accumulated depreciation will get a credit of $7,000. We are not posting cash. The only reason we're not posting cash is because in the exercise it says that we're using equipment, accumulated depreciation, depreciation expense. We could easily throw in a T account for cash there too, but we're just following the requirements of the exercise itself. Okay, so the first thing, the first one, equipment. We saw back there, equipment had a debit of $35,000. So we're going to, in the T account, put the $35,000. That was the adjusting entry. That's the only activity in the equipment account, so we can draw a line and drop the balance in there. Next up, the depreciation expense. We had a debit for $7,000 there. So we'll put that in the account, draw a line, drop in the balance. And then accumulated depreciation is going to have a credit, because that was what we credited in the journal entry. So on the credit side, the right-hand side, we'll drop the balance in there too. So those are our adjusting entries for depreciation. Well, our adjusting entry. Their adjusting entry for depreciation is always going to debit depreciation expense, credit accumulated depreciation. Accumulated depreciation is a contra asset, has a normal credit balance, and it's a running total of all our depreciation to date for all the years in a particular category. Questions about that one? Okay, so we started out doing prepaid. We did some deferral journal entry, adjusting entries. We just did the depreciation adjusting entries. Next up, we're going to do one more homework problem right now, and that is on the accruals. So deferrals, cash has already changed hands. Examples of deferrals are we paid our rent in advance, or we bought supplies and now we use them up. Cash has already changed hands. Now, accruals are the opposite. Accruals, we haven't paid for it yet, but we need to acknowledge that we've incurred it. So, oh, I'm sorry, there's one more part of this. I forgot. Okay, so what is, I'm going to take that one. Okay, so I'm not going on to exercise 10 yet. I'm going to finish this one because we have one more question, but I'm also going to answer Andrew's question. How would you figure the accumulated depreciation for something like computers which depreciate so quickly? So when we get to the plant asset chapter, we're going to be talking about this, but basically companies depreciate assets over their estimated useful lives. So you look and you see, what do you think is useful? What is a useful life for a particular class of asset? So when I look at computers, most companies depreciate computers over 3 years. 3 years is a typical life for computers in depreciation terms, whereas if you have a building, it could be 30 years, it could be 40. There's specific guidelines, what you would expect to see. Of course, if our useful life's different, we would make that different. Automobiles are an interesting case. Estimated useful life says how long is it going to be useful to us. So an automobile, I may buy an automobile for use in my business, and I know that automobile will probably last for 10 years. However, in my business, I'm only going to use it for 5 years. So it has a useful life of 5 years, and we'll get more into the details of what happens there. But there are different estimated useful lives depending on what the asset is underneath. Okay, learning catalytics will always be for participation until I say otherwise. Okay, so we'll not make an announcement at the beginning of class someday if it's not for participation. Assume it's participation until you know until we announce otherwise. Okay, so this question, we had one more part to it, book value. Book value on an asset, real quickly, on a plant asset is always its original cost less accumulated depreciation. So the book value on this particular problem is going to be its original cost of $35,000 less accumulated depreciation. I just show parentheses there to show it's being subtracted. So the book value of this equipment is $28,000. Okay. So book value is original cost minus accumulated depreciation. And on the balance sheet, when a company shows its plant assets, it's going to show the $28,000. Okay. In the notes to the financial statements, they're going to show the accumulated depreciation. But typically, when you look at a balance sheet, many times you look at a balance sheet, it's just going to show the $28,000 book value.
Or value in the middle of the 5 years. There's no years attached to the dates.
Okay, the question is when is book value? When is book value shown? Book value is shown at the end of every period, and it's accumulated depreciation always has a balance in it, and it's all the depreciation expense. So it's after, like this, we know it's for 1 year because it's $7,000. Next year, accumulated depreciation will be $14,000. So you'll have a book value of $35,000 minus $14,000. It's just gonna. It's what is the book value at December 31st? We're assuming it's this first year. Yeah, and you're not going to have, in this chapter, absolutely, you are only in the first year. Okay, now we can go on to exercise 310, and this has to do with accruals. Accruals, we have, here's an example. Perfect Travel Services borrowed $75,000 on October 1st by signing a note payable to the bank, and the interest expense for each month is $312. Okay, and the loan agreement requires the Perfect Travel to pay interest on December 31st. So the first thing we're going to do is make their adjusting entry to accrue monthly interest expense. No, we will not need the depreciation value in the middle of the year. We're going to go with whole years in this first, when we're dealing in this chapter, we're only looking at depreciation for a whole year. When we get into that later chapter, we're going to be looking at partial years and things like that, but not in this chapter. Okay, so Perfect Travel's adjusting entry. So they've taken out this loan for $75,000. The interest expense is $312, but they don't pay it till the end of the year. So what we're going to do in October is October 1st, we sign the note. So at the end of October, we owe $312 of interest expense. We're not paying it till the end of the year. We're making all our interest expense payment in one payment at the end of the year. So what we're going to see in October, at the end of October, is we're going to debit interest expense and credit interest payable. So this is an accrual adjusting entry. And then we're going to make that same entry in November and December. Okay, so this is the first requirement. So we're still on requirement 1. So it's saying make the adjusting entry at the end of each month. Adjusting entries are made at the end of the month before we prepare any statement for the month. So we want to show that each month we're incurring interest expense. The interest expense on that loan is they tell us it's $312 a month. So at the end of the first month, we owe $312 of interest. We're not going to pay it till the end of the year, but we have used that money for a whole month, so we need to recognize that we have interest expense and that we owe this interest. Even if we paid off the loan today, at the end of October, we still owe the $312 for using that money for the month of October. We're going to do that same thing for November. There is no such date as November 31st. That was a copy and paste gone bad. Okay, so you're taking, okay, so November interest expense is also $312, and then December we do the same adjusting entry. So basically when we're making an accrual entry, we're going to debit the expense and credit the payable when we're talking about an expense. We're increasing expense each month, increasing payable. So we have the same adjusting entry, just October 31st, 3 times we need to recognize it each month. So what we do then is, it tells us in requirement 2 to post all 3 entries to interest payable. Okay, so we're going to have a T account, and interest payable, October 31st gets $312, November 30th gets $312, and December 31st gets $312. The total then is $936, and it's on the credit side because we credited that. Also, payables is a liability. Liabilities have a normal credit balance. So the balance of the interest we owe at December 31st is $936. It's $312 each month. We recognize it each month because we need to show the expense when we incurred it, and we also need to show that we have a liability. So then the final part of this is not an adjusting entry, but it's saying record the payment of the interest on December 31st. So we do all these entries, and then December 31st, we pay the interest. What's going to happen there? We're paying out cash, so we're going to credit cash. We're going to debit that liability. Okay, so we see the debit to interest payable. Interest payable is a liability. We built it up on our books. We owed $936 on December 31st. We're writing a check for it right now. So we are going to debit the liability to wipe out the liability. We don't owe it anymore. and we're going to credit cash because we're paying cash out the door. Okay. Yes. The adjusting entry? The adjusting entry is debit interest expense and credit interest payable for $312. And that would be the same all 3 months. Debit interest expense, credit interest payable. Okay, we have another homework problem on adjusting entries. It gives good practice. I'm sending the video out on this because, again, these first few chapters are so fundamental that if you need more practice or you need more help, I have a video. I'll send out the links probably early tomorrow morning. I'll do a video for exercise 320. That's on your homework this week. So if you want the help on it, that's coming. And this is excellent practice. It's more adjusting entries like what we just did. Okay, so a question and then we're going to move on. Blank will be increased when a company receives cash before performing the services. So what will be increased? This is a transaction. What are we going to increase if we get cash before performing a service? Think lawnmower guy. On Monday, we talked about lawnmower guy getting $600 in May for lawn mowing he's going to do in June, July, and August. So what is increased in that situation when the company gets cash? Obviously cash is increased, but what else is going to be increased? Where are you, pen? Okay, we're going to close this question about 10 seconds. Make sure you have your answer in. And the answer here is unearned sales revenue or unearned revenue. Unearned revenue is a liability account. It's increased with a credit. So this is a customer pays us in advance, and so we have a liability until we perform the service. And that is a deferral. Cash is, if the deferral cash is received first. Okay, so what we're going to do now is we're going to move on to constructing financial statements. Now this one, I'm just going to point out some sample financial statements in your text. You can use as models, and then I have a couple of videos that I'll be sending out if you need help with this. We have 2 balance sheet formats, 2 income statement formats. The balance sheet format, this is Exhibit 3-14, and this is a balance sheet format that is in report format. All that means is that everything's listed top to bottom. So we have assets, and then down below that we have liabilities and equity. It's just listed as a report. And then the balance sheet account format lists the assets on the left and then liabilities and equity on the right. What companies do is a matter of preference. So we have balance sheet report format, a balance sheet account format. Then that's Exhibit 312. Then we have income statement single-step format. Single-step format is Exhibit 310. You're going to see some of these in the homework. Just want to explain why they look a little different. Single-step basically says, let me list all my revenues, and then let me basically list all my expenses, except for income tax. And that's what I'll do, single step. Revenues minus expenses gives me net income. And income tax is always treated a little bit different than everything else. So single step, everything's kind of just lumped together, as opposed to the income statement multi-step, which says, let's get our net revenues, then let's subtract cost of goods sold and get operating income, and then let's subtract our gains and any losses. So we have lots of steps involved. So that's just a preference. Most companies are going to use a multi-step income statement, but I know some of the homework to make it easier just does single step. So I want you to be aware that they are different, and companies typically use this multi-step, but it can get pretty involved. Okay, and these financial statements that we do in this chapter are much like what financial statements we did in an earlier chapter. So what I'm going to do is I'm going to have videos coming for short exercise 313 on the homework. So there'll be a video coming for that one. And then, so if you do need it, and then there will be a video coming for short exercise 315 as well. So then that brings us to our next learning objective, closing the books. Now closing the books is basically we get to the end of the period and we have these expenses and these revenues that we need to zero out for the next period. When we start January 1, we don't have sales for the year yet because the year hasn't gone by. So we have to reset certain accounts to zero. We do not reset assets and liabilities because assets and liabilities continue. For example, cash. Cash is going to continue because just because it changed years, our cash didn't disappear. We still own it. We still own our building that's an asset. So we don't close assets or liabilities. We don't close common stock. But we close the temporary accounts. These are the temporary accounts are revenues, expenses, and dividends. Those are all accounts that have to be set back to zero at the end of the year to start the next year. Okay, so we have temporary accounts. Temporary accounts are the accounts that are closed. Permanent accounts are assets, liabilities, equity being things like common stock and retained earnings. Revenues, expenses, and dividends all get closed into retained earnings is what we're doing. So we have to set those accounts, the temporary accounts, to zero because nobody starts January 1st and says, my sales are $15 million for the year so far. No, that was $15 million last year. So we just need to reset the counter on these accounts. Okay, so what we're going to do, we have these temporary accounts, we have the permanent accounts. You need to know which kind of account is which. You do need to know that. So know a temporary account, know the permanent accounts. You're going to close to do closing entries. There's 3 types of closing entries. I always remember it with the acronym RED, revenues, expenses, and dividends. Those are the accounts that are closed. Okay, so this is something you do at the very end of the accounting period. So what we're going to do is we're going to close revenues. If you have, probably should download the PowerPoints. If you don't have them already, you can grab this slide if you want it. But we close revenues. We debit every revenue account. Revenues accounts have a normal credit balance, so what we're doing here is we're wiping them out. So the closing entry, every time we do it, it's going to look the same. We're going to debit every revenue account. We're going to credit retained earnings because we're taking all that revenue and putting it in retained earnings. Because retained earnings is a running total of all our income to date. So we're going to put our revenue into retained earnings. Then with expenses, we're going to credit every expense account. The total of all those expenses are going to be debited to retained earnings. So they're the reduced retained earnings. And then any dividends that we declared and paid, we're going to debit retained earnings, credit dividends. The closing entries will always look like this. Okay, always. You're going to, for closing revenues, you're going to debit every revenue account. You're going to credit retained earnings for the total. For closing expenses, you're going to debit retained earnings, credit every expense account. So your closing entries are entries that you make to reset the counter on the accounts that are temporary, those one-year counter accounts. What we're going to do now is I'm going to do an example. And again, you're probably not going to be able to write down all the numbers, and this would be where you could download the slides and have the numbers in front of you. So basically on trial balance, you're closing everything below retained earnings is another rule of thing. If you've got them all arranged on a trial balance, it's everything below retained earnings gets closed. So here's our facts. So we're doing this example. I'm going to show you closing entries. They're not bad. There are 3 closing entries: revenues, expense, and dividend. I know that because I can remember the RED acronym. So it gives us here a list of the account balances at the end of the year. And they're jumbled up. They're not in any order. We have cost of services sold, which is an expense, accumulated depreciation. We've got a lot of accounts there. We don't close every account. We only close revenues, expenses, and dividends. So what we're going to do is we are going to close our revenue accounts first. So we're closing the revenue accounts. That's step 1. Close revenue accounts. So what we're going to do is we're going to have to locate in the list any revenue accounts we have. I see service revenue there for $63,800. I also see interest revenue for $800. So you just go through the list, look for your revenues. So revenues have a normal credit balance. I know that because we went over that. Oh, that's one of those fundamental things we need to know. Normal credit balance, so I'm going to debit every revenue to wipe it out. So I'm going to be debiting service revenue for the $63,800. I'm going to debit interest revenue for the $800, and then my credit is to retained earnings, and it's the addition of those 2 things because my debits have to equal my credits. So my $63,800 plus $800 is $64,600, and that is my closing entry for revenues. So that's one of 3 closing entries I may have. Service revenue is being decreased by $63,800 here because it had a balance of $63,800. Its normal balance is a credit balance. What we're trying to do is get those account balances to 0. Okay, so we're wiping them out. We want on January 1st to have 0 service revenue because we don't have any sales next year yet. So we're taking the balances and wiping them out by debiting them because it's a revenue. Revenues normally. Pardon me? Yes, the temporary accounts, our objective is to make them 0. Closing entries never, ever, ever affect cash. Cash has nothing to do with the closing entry. If you're reading a multiple choice question about what is the closing entry and there's cash in it, you can cross that option off right away. Cash will never be in a closing entry. Cash has nothing to do with closing entries. We are simply taking our temporary accounts and making them all 0. Okay, next closing entry. So that was closing revenues. So our next one is to close expenses. So we'll close expense accounts, and what we need to do there is we need to identify all our expenses. So cost of services sold, that's an expense. Cost of goods sold, cost of services sold is an expense. Selling, general, and administrative expenses, depreciation expense, income tax expense. So those are the expenses that are given, and we need to close those. Now, when we close those, expenses have a normal debit balance. To get rid of them, we will credit them. So if we have a debit balance of $28,600, to close it, we need to credit it. So to close expenses, we will always debit retained earnings for the total. So where did I get the $50,800? I added those 4 expenses up. Those were the total of my expenses. So then I'm going to credit cost of services sold for $28,600. That makes that 0 for the start of the next year. I credit selling, general, administrative expense for $12,800. I credit depreciation expense, and I credit income tax expense. So I'm taking the balances of all those expense accounts, crediting them, and then that total is what I'm debiting to retained earnings. So, yes. Where did I get $50,800? That was the total of the 4 expenses. My debits have to equal my credits, so I actually did it after. I added up all my expenses. I debit retained earnings for the total of all my expenses, which is also those last four added together, because my debits have to equal my credits. So I could do the credits first and add them. That's where I get them. Okay, so we've done the revenue closing entry, we've done the expense closing entry, and the next closing entry, companies may or may not have it. If they declared and paid a dividend, they will have it. If no dividends are mentioned, you don't need this next one, but you look for dividends. Closed dividend account. So what you're doing here is we're looking to see if they paid dividends, and they did. They have dividends of $600. So to close dividends, dividends has a normal debit balance, so we're going to credit dividends to wipe it out to zero, and we're going to debit retained earnings. So we're going to debit retained earnings, credit dividends, and that will be our closing entry for dividends. Okay, now what we've done, we can answer a few questions from what we've done so far. First of all, what's net income for this company? Well, the net income for the year is going to be our total revenue minus our total expenses. So if we went back in time to these other entries, let me go back to my closing entry for revenues. Okay, my service revenue and interest revenue combined were $64,600. So that was my total revenue. We're looking for what our total income is. So then my expenses totaled $50,800. So now when I answer the question about what is net income, okay, how much net income? Our total revenues were $64,600, and that was that first closing entry. It's also interest, service revenue and interest revenue. Total expenses were the four expenses added together, and I'm off here. Oh, the spacing got off. Okay, so my net income would be my total revenues minus my total expenses. Dividends never, ever, ever impact net income. Retained earnings, yeah. There's three closing entries. We just went over them. Retained earnings is credited when you're closing revenues. Retained earnings is debited when you're closing expenses, and retained earnings is debited when you're closing dividends. Okay, and then one last question here. It says, let's prepare a T account for retained earnings to show what the balance of retained earnings is. So our beginning balance is over there, $5,200. This was given to us back in the very beginning when we were given that table of data. We started with a balance of $5,200. Unless told otherwise, retained earnings has a normal credit balance. So we started with this balance of $5,200, which we got from the initial data given to us. Then we closed revenues. Then we closed expenses, and again, these were the entries to retained earnings. So we credited revenues for, we credited retained earnings for revenues as $64,600. We debited expenses of $50,800 to retained earnings, and we debited dividends. So when we're all done with that, we can add the $50,800 and the $600 together, and then we add the $5,200 and the $64,600. We take the total of the two sides. The difference between the two sides is $18,400, and it goes on the side that's greater. So this is a credit balance of retained earnings. Retained earnings is a running total of all our net income to date, less any dividends that we've declared and paid. Okay, questions about that? Okay, I am sending videos out for the rest of the homework problems. Again, since this is a fundamental chapter, I won't do that every week. And again, if you were not here, but if you were not live online Monday or didn't watch Monday's recording yet, you need to. There's some exam information in there it would be helpful to do. I'm going to run through it really quickly now, and in about 5 minutes I'll open it up for questions. Okay, so again, I'm going to run through this, take questions. And exam is next Monday through Wednesday, and I went through this in greater detail Monday, so some of it's going to be there. It is chapters 1, 2, and 3. It's everything to date. All time zones on exam, when I talk about the exam cutoff times, they are in Eastern Standard Time. Sections 1 and 2, you have to take the exam in the computer lab in the College of Business, second floor. You have to, on Monday and Tuesday, you would have to be sitting there starting by 7 p.m. They will not let you start the exam after 7 p.m. Wednesday, the last day of the exam, you have to start by 4 p.m. Lines may be long. Last year, the exam before spring break, the lines were 3 to 4 hours long. There were no lines on Monday and Tuesday, and very few lines first thing in the morning Wednesday. If you wait till 4 p.m. Wednesday, keep in mind that I have over 300 students taking the exam in the computer lab. That means you're going to have a lot of company in line if everyone procrastinates. You do it at your own risk, but you have to start by 4 p.m. There are no appointments, and again, everything that I just said applies only to sections 1 and 2. You need to verify, click on exam info in Blackboard. It should tell you if you're in sections 1 and 2, it'll tell you you're taking it in the computer lab. When you sign in to My Accounting Lab, it should say section 001/002, or yeah, I'm pretty sure that's how I named that section. So you cannot take it anywhere else. It's not going to work. You have to bring official ID and a writing utensil to the lab. They don't have pens for you to use. Bring your own writing utensil. Bring your own. You bring your photo ID, official photo ID. They will provide for you the calculator, the exam equation sheet, which we'll talk about in a minute, and scratch paper. All of that will be provided for you. All you're going to bring is a pen and photo ID. This is sections 1 and 2. My next slide, again, we talked about this in length on Monday, sections 5 and 6. You take your exam on your own computer in private location using ProctorU. You have to have a webcam with audio and high-speed internet. Test ProctorU on your equipment before Monday. I have sent emails and announcements out. I'll take questions at the end. I'm going to answer all those questions in the chat room, so you'll just scroll through for me. So hold your questions for right now. I will get to those. Okay. So the hours for the exam are exactly the same. You have to start your exam by 4 p.m. on Wednesday. Proctor hours for the lab are on exam information on Blackboard. Okay. Schedule your exam with ProctorU at least 72 hours in advance to avoid a convenience fee. As of yesterday, only 25% of the students in section 5 and 6 had scheduled their exams with ProctorU. That means the earlier you schedule, meaning the earlier you sign up, the better your chance of getting the time slot you want is. So they can't accommodate all 250 students at 4 p.m. Wednesday either. If you wait till Wednesday afternoon to take it, that is when something will go wrong. So you want to sign up in advance. You can use a non-programmable calculator. For ProctorU, you supply your own blank scratch paper. You will have to show them it's blank. You will provide a pencil. You will need official photo ID. You will need a non-programmable calculator, not a TI-83, not a TI-89, not your phone. And ProctorU will give you a PDF exam equation sheet to use. Okay, so you will use the sheet, and we'll talk about that in a minute. Okay, so everything I just said was either section 1 and 2 or 5 and 6. You all start the exam Monday at 9 a.m. It's available to start until 4 p.m. on Wednesday. Check Blackboard for specific proctor hours if you're in sections 1 and 2. Everyone has the exam available from Monday 9 a.m. until have to start it by Wednesday at 4 p.m. Okay, exam basics. There is a 120-minute time limit. I'm going fast here. We covered most of this on Monday. 3 to 4 exercises constituting, again, okay, exam equation sheet. Haley and I created an exam equation sheet that lists some basic information you do not need to memorize for the exam. You can see that on Blackboard now. You will get that sheet. If you're in the lab, they will give you that sheet. If you're on ProctorU, they will give you the PDF. You cannot bring your own notes to the exam. Okay. And this note sheet is available on Blackboard. I would urge that you download it. It is what we're providing for the exam. Do not rely on the ending time in My Accounting Lab. It's a time due. You have to start it by 4 p.m. There is a long explanation for why it's not 4 p.m., but just know you have to start that exam by 4 p.m. Wednesday. Okay, if you're in sections 5 and 6 and you didn't schedule your exam in advance or anything goes wrong, call ProctorU on that last day. You cannot schedule online the last day of the exam. And you probably will have to leave a voicemail and they will call you back. Okay, no curve on the exam. Basic rules. Please do not have a cell phone visible. Don't violate any of these rules. No notes other than an exam equation sheet that I provided for you. No other windows open other than the exam. And if you're in section 5 or 6, you'll have the exam notes open, the equations. If you're in section 5 and 6, you have to submit the exam before you close the Proctor window, because there's a person, you can't close them and then continue on the exam. You have to close the exam. Automatic 0, if you violate any of these, please do not violate. I think it's been a year since I've had to report anyone. My job requirements, university policy states that if anyone violates exam protocol, I have to report you. I am not going to be called up on an ethics violation for someone that violated a rule in the first place. So if you violate a rule, you're being reported to student conduct. Don't do this, please. I haven't had anybody in a whole year, and that's wonderful. It breaks my heart when someone does something. Okay, detailed exam information. Any issue during the exam. If there is any issue during the exam, it is your responsibility to email me right away, even if the proctor says. So this could be a proctor in the computer lab or a proctor here, or on ProctorU. If they say, oh, we'll contact her for you. This is your exam. It matters more to you than to any proctor. It is your exam. You need to contact me right away. Believe me, I am watching my email. I am monitoring it, and I will get back to you. There is nothing we can't solve, but you have a responsibility to contact me and stay in contact with me. Don't send me an email saying, oh, this wouldn't work, and then contact me 3 days later. Guess what? You don't take your exam then, okay? Exams have to be started by 4 p.m. Don't wait. The lines will be long. No makeups. The single biggest problem when people go to take their exam is they've forgotten their My Accounting Lab login because they saved it on their computer. They go to the lab, and it says, I don't have a subscription. What's wrong? What's wrong? You forgot your My Accounting Lab login, or you let My Accounting Lab expire. Either case, it doesn't work. So know your login and password. You have to take your exam in the location for your section. It is not optional. If you show up in the computer lab and you're in sections 5 and 6, it will not work. If you try to sign on to ProctorU, it will not work if you're in sections 1 and 2. It is not an option. There is an exam info quiz. It is due this Saturday. It's about the exam, and it counts as a quiz, maximum 2 attempts. There is also a practice exam in My Accounting Lab. This will be available until Wednesday. I said 9 p.m. Basically, take it before you take the exam, okay? The practice exam counts as a quiz. It is required. You have a maximum of 5 attempts. Your score is the average of all your attempts. I cannot stress enough the value of this practice exam. If you take the practice exam and you score, say, 60% on it, and you go, oh, I know what I did wrong, it'll be fine. I would expect that your exam score will probably be in the neighborhood of 50%. That practice exam, usually what you get on it, your score in real life is going to be a little bit lower because you don't have all the resources to help you. Very highly correlated. Now keep in mind the practice exam is no time limit, but your exam has a time limit. And I've included the Help Me Solve This and those things on the practice exam, which are not on the real exam. This is required, and I would take it. You don't have to take it 5 times. I think it's a good practice tool. Don't waste your attempts, though. Don't just take it blind and see how you do. You may want to study a little bit, then take it, assess where you are, then study in between. Just taking it rapid fire 3 or 4 times in a row probably isn't going to get you increased scores. So know that that practice exam is there. So again, there's 2 quizzes related to the exam. The exam info quiz is due this Saturday. The practice exam is due before you take the exam. So now I'm going to go back to questions here. Okay, so, how to contact Proctor U for exam appointment, that I've emailed out to you. That's check your email, check announcements. Okay, I'm going to open it up in front of me. You can answer some online if you can now ask Haley questions. I'll watch it. Anybody in here have questions? Yes. Can you use your own calculators in Computer Lab? No, you will use their calculator. Yes. I'm sorry. So you talk a little louder and I'll get a little closer. Yes, what? You can test anytime the computer, if you're in sections 1 or 2, your proctor hours dictate when you can do it. So you would start Monday and Tuesday and Wednesday, the proctor lab opens at 9 a.m. and it closes at 9 p.m. on Monday and Tuesday, so you have to start by 7. You could take it any time, and then Wednesday you have to start by 4 p.m. But the is that what we were getting to? Okay, the proctor hours for sections 1 and 2 are on Blackboard. Okay. Okay, and you can, when you're taking the exam, it's just like My Accounting Lab. That's one of the reasons that I'm providing the practice exam. You can hop around in My Accounting Lab, the practice exam, and that's very much what the exam's going to look and feel like. It's going to have homework problems on it. It's going to have multiple choice on it. This practice exam is set up to give you that experience. You will not have the Help Me Solve This or anything on the real exam, and the real exam will be timed. But it's going to look just like the practice exam. That's going to give you your experience. Can we bring the exam equation sheet to the computer lab? No. The computer lab will have the exam equation sheet for you. Proctor U will push it out to you. It's already provided on Blackboard for you, so you know what's on there ahead of time. Okay. What else? Anybody else? Okay, we do not have class next week. So we will not see you for another week. Are there any other ones? Who do we contact if we're in section 5 and 6? I assume you're asking to schedule your exam. You would contact Proctor U. If you're asking about if there's a problem with your exam, again, you would email me. But if you're talking about Proctor U, you email them or call them. But if there's an issue during your exam and the proctor says, oh, I'll contact her, you need to contact me as well. Okay. Okay. Well, good luck, and I will see you in a week.